All right, welcome back to another episode of Investing Wizards. I have Travis Devitt of Stock Geek TV, aka Stock Geek TV, who has a YouTube channel, is a former hedge fund analyst, and is a really interesting guest. So welcome to the show.
Thanks, Rob. Happy to be here. Thanks for having me.
Awesome. So can you tell people out there, like, what's your background? How did you get into investing? Sort of start kind of like in school and maybe right after school.
Yeah. I had a pretty traditional path. I went to UT Austin, which is a pretty good undergrad finance school. Went and interned at Goldman Sachs, worked for a hedge fund of funds while I was in college as well, and then pretty much got to the buy side as fast as I could. So my first job out of college was actually working at a long-short hedge fund on the West Coast called Stadium Capital. And I was there about a year and a half. And then I was lucky enough to be able to come back to Austin and join a fund called Teton Capital Partners, which files its 13F under Ancient Art. And at the time, Teton was a pretty small up-and-coming fund founded by a portfolio manager named Quincy Lee, very, very sharp investor. And, we grew that from about 150 million of AUM to well over $1 billion. And I think today they're probably pushing over 2 or somewhere in that region. But, just very deep fundamental work. We were pretty much, I would say, opportunistic investors. We mostly did equities on the long and short side, both domestic and international. We had a pretty significant presence in like Asian equities and European equities as well. But occasionally we would wander into the world of distressed assets and things like that, like during the financial crisis. So just a great place to be able to hone the investing skill set.
Awesome. And so it sounds like the way that you learn investing is just a very fundamental bottom-up approach to picking stocks.
That's right. Yeah. And my style has probably morphed over time, as most people's have and should with the markets. But yeah, we look for, I typically am looking for kind of a medium to longer term holding period, stocks that can be up at least, stocks that can basically be multi-baggers over the next 3 to 5 years.
So medium to long term means 3 to 5 years.
Yeah, I think, average holding period for me really depends on kind of what happens with the stock. There's been times where we've gone in and done something opportunistic with, say, a stock that's got an activist involved and it's over in 6 months. But yeah, I love to find ones that we can hold on to and just enjoy the compounding over 3, 5, 10-year timeframes. But they're getting more and more rare.
Yeah.
Valuations like they are now.
Yeah. And then is there kind of like a memorable stock from your time at Teton that was something that you focused on and really remember as a standout?
Yeah, we had a lot of interesting situations that we invested in. We were, especially after the financial crisis, there were so many interesting opportunities. But I think one that sticks out that I call kind of my best and my worst investment from early days at Teton Capital Partners was Booking Holdings, formerly called Priceline. And when we had been doing work on the travel sector, on the online travel sector specifically, before the financial crisis. And there were some businesses we liked in that sector. And Priceline was one that we thought was probably the best company in the sector. And it was pretty pricey at the time. We had a hard time figuring out if the valuation made sense. But of course, 2008 sell-off hit and we nearly bottom ticked the stock. We were able to buy it at $50 a share, which was, I think at the time, 10 times trailing free cash flow. And there was a lot of uncertainty, obviously, about the economic environment, but, we were pretty happy about our buy. And then I think within like 6 to 12 months, the stock had tripled. And so great result. We ended up selling most of our position after like a 3X, thought we were geniuses. And then of course it goes on to go up, more than 10X over the next decade. And so we left so much money on the table. So one of my biggest investment mistakes, even though it was technically a win. So, we followed the sector for years after and made other investments. So it was definitely one where we were able to use a lot of the same work, but lots of lessons in that one from Booking.
So that's a good point to kind of ask about, like, in this investment style. I think one of the toughest decisions an investor has to make is when to exit a position, whether it's Booking or we're thinking about some of the stocks now which have ran up like 3X, 4X, 5X. Mm-hmm. How have you honed that process and that skill in terms of holding a stock like Booking back then and knowing like when should you exit? How do you think about the story, the valuation, technicals? Like, what's that framework that you use?
Yeah, it used to be that I would just use the valuation and the stock price that the model was spitting out. And, that's a pretty naive approach, I think, because as we've seen in most markets, things tend to run a lot longer and further than you think it will, for a couple of reasons. One, because there's momentum in markets that tends to work, but also because companies compound value in ways that are nonlinear. So I think those things have helped me over time do more of a scaling in and scaling out approach. And so it's kind of a combination of art and science where, I'm allowing myself to take profits when things are hitting my targets or above my targets, but I keep runner positions on regardless of that. And so that's helped me to be able to capture profits, longer than I might otherwise think the stock will be giving us, more upside. So it's still a work in progress. Like my biggest mistake is selling too early on most of my winners. And so, Wayfarer is a recent example of that. There's been some interesting stocks that we bought during this most recent downturn in March and April. And so, some of those stocks rallied so hard, so fast that it's hard to mentally not take profits, but it's something I'm continuing to work on to get better at, but definitely the scaling in and out strategy, I think, is one way to kind of tackle that.
So it's interesting. So you attack that, or you answer that by saying like more like it's a sizing problem rather than kind of like it's not binary. And if a stock runs past a fair value or some target you have in mind, maybe you'll reduce the position, but you may not necessarily get out of it as you had done before. And that's something that, like, if you read these books where they interview all these professional investors, people talking about just sitting on their hands, riding a trend and really not trying to second guess like how far something could run. And we've seen that with so many stocks today, like, Amazon or Shopify or whatever it is, where sure the stocks can, like, you can argue the stocks are expensive today or they've run too much, but you would have missed those profits or a chance to kind of maybe reduce your position and capitalize on the momentum on that trend, instead of just being very naive about like having some model that says, hey, this is the price target and above that it's expensive or whatever it is.
Yeah, 100%.
Got it. So lesson here, sit on your hands. Don't do anything. Sometimes that's the most profitable strategy. That's cool. And then can you just tell us, so background, kind of like very interesting in terms of like learning how to invest. Like, what are you up to now?
Yes. So I left the investing world after about a decade working at hedge funds, and I wanted to either start a company or help build kind of an early stage tech company. I wanted to get that operating experience. And so after hedge fund days, I went and spent 4 years helping build an ed tech startup here in Austin. And that company's done really well, still alive and kicking with a really good valuation. So hopefully, knock on wood, they get an exit in the next couple of years. But after that, I basically was back to the drawing board of, okay, what is it I want to do? Do I want to do the operating side or do I want to do the investing side? And I kind of decided that I wanted to combine them. One of the things that I've had friends and family constantly ask me over the years is, where do I go to learn about investing? How do I learn to invest in stocks? And I couldn't ever point them to like a perfect resource to do that, either online or through books or anything. So I basically decided that I was going to build investing courses and try to be like the face of investing education, or at least someone who helps, contribute to that. And so I started working with a business partner, Chris Dunn, who has a investing community called the Skill Incubator Community. And so he was mostly focused on the cryptocurrency asset class. And I joined him and helped build out the stock side of his community. So we do market updates and watch lists and help do education about stocks. And then I also started up my Stock Geek TV YouTube channel and have been writing about certain stocks and building online investing courses. And so the idea or the goal is to actually be able to, deliver really high quality investing education online for people. So that's the dream, and still working on it, but have some pretty interesting products lined up, hopefully to help people learn investing.
That's awesome. And like I'm on YouTube now more and more with Koyfin and just checking out other videos. And I get bombarded with these ads all the time. Like the guy on the plane with the money and the cash. and the guy was
Yeah.
like, "Hey, do you want to make $100,000 or whatever it is?" And I can't believe people still click on that stuff of the kind of like clickbait, fly by night operators who are just like, "Hey, sign up for my course," and it's clearly that like just based on the ad, that they're just going to rip you off. Um,
Yeah.
is that like, how do you think about yourself? And you have like a grounded background in providing value. How do you think of yourself trying to compete with some of those gimmicky offerings?
Yeah, that's exactly the frustration and I guess you could say sort of inspiration for doing what I'm doing, because for so long, like the scam artists and the like marketers who don't really have formal training in investing are the ones who have dominated investing advice online or investing education online. And so, that's what I'm out to try to counter and basically be an alternative to. And that stuff's always going to exist because people want the easy way out. The idea of turning $500 into 5 million in a year is always going to be interesting, especially for younger, more naive investors. But I think what I'm trying to do is provide like a really, really deep, kind of almost university level type of education and investing. And I cover a lot of different topics, everything from, what are the different asset classes you can invest in, and compounding and basic concepts like that, all the way through to finding stock ideas and even doing financial modeling and looking at financial statements and things like that. And the reason I have done such the wide breadth is so that it's kind of, hey, I know there's a lot of people out there who just want to pay an advisor or pay a fund to do it for them. But there's also a lot of people out there that just want to at least know a little bit more about what's going on and know what happens when a stock moves 25% because of an earnings report. And so that is hopefully what I am going to be able to put out there for people, is stuff that people can actually choose what they want to learn about and how deep they want to go. And it'll actually have, some real meat behind it. And I'm not ever going to be able to stop the scam artists from scamming, but at least there'll hopefully be something out there that's better. And I'm not the only one doing it, obviously. I think I've started to see some others emerge out there on FinTwit and in different corners of the internet that are starting to put out good investing content. But, hey, we're just trying to chip away at that crew of people who have been ripping people off for 10 or 20 years.
Yeah, so it really kind of pisses me off when I see those commercials, because they're obviously scams. And then, as you're teaching this course for new investors, is there kind of like a skill or a concept that you think is like the toughest for new investors to pick up, that you kind of like, in terms of someone who's starting out to someone who starts to understand what they're doing? Is there one concept or maybe a group of related concept that you think is the toughest to pick up? And we just talked about maybe when to exit a position. It sounds like you and I are still learning that concept, but anything else that's that you've noticed, like from new investors as they're starting to learn about stocks and how to invest?
Yeah, I think valuation is probably one of the toughest topics, because you can talk about DCF models, you can talk about valuation multiples and how those things interrelate. And even professionals, like we have this weird distinction, for instance, between growth and value investing for some reason, but it's all really the same when it comes down to actually doing real valuation work. You're looking for undervalued companies relative to future expectations. And so valuation is difficult because a lot of like investors, once they start going through it, there's a lot there. Like you learn DCF and then you connect DCF to like earning. Well, what is earnings? Well, how is it different than cash flow? And then like, okay, well, if I'm going to use an earnings multiple or a cash flow multiple, how do I determine what the multiple should be and things like that? And then you've got, with all the companies that people are most interested in today, it's the recent IPOs, the hot growth companies, and valuing those kind of companies with any sort of certainty is like really, really hard, because how do you forecast 10 or 15 years out for Shopify? And what's the right, either discount rate to use or what's the right valuation multiple to use? You could make a case for 30 times sales, or maybe you could make a case for 10 times sales, right? So that valuation is just really tough because it's a broad topic with a lot of concepts within it, and it's kind of wonky. And it's also like, when you're trying to apply it to real stocks, the application of it's actually pretty hard. But I try to at least break it down in ways that are lots of different actual examples. That's why like we love Koyfin, and I have Koyfin like littered throughout my course, because we can do a lot of real world examples showing like, well, here's how multiples tend to compress over time as companies mature and things like that. And So Koyfin's a great tool.
Thanks, Travis. Flattery will get you everywhere, and you'll be invited, you'll be invited back next week for sure. And then, so interestingly, I saw a tweet the other day from Liberty on Twitter, who is a friend, and he said something which was very interesting, and he said that he has never used a discounted cash flow model, and he's never met any kind of like serious valuation investors that have used a discounted cash flow model. Have you used, like when you were at your hedge funds, did your team have DCFs?
It's interesting. At the first fund that I joined right out of college, we did build pretty sophisticated, deep DCF models. And I felt like at the time, like, this is amazing. The precision we're getting an exact price target, or at least, multiple price targets for different cases that we can work off of. But there is false precision there, especially with companies, like I said, that tend to be a little bit newer, more high growth mode. So I don't, at Teton, we didn't do full DCF models. We did modeling work, but it was more to get an idea of, well, how much cash flow can this company generate in 5 years or 10 years? And then we would kind of determine, well, what do we think the market's going to value that, in a few years or even a year or two from now? And so I think that's a pretty good kind of blended approach to use. And that tends to be the approach I still use today. I don't always build models for investments that I make. Some companies I think are more simple to understand and have especially the ones that are more mature, you can apply earnings multiples or cash flow multiples in a more simple way. But DCFs I think are still, I think the part of the DCF models that are actually useful are building out the drivers for like revenue and cost for a company, understanding like what levers can they pull to drive higher margins over time or something like that. So I think the war against DCF is like, it's kind of like counterproductive in some ways, because I don't think we should totally just get rid of modeling altogether, but I can see the criticism there.
And I love the concept you just mentioned of false precision, because any buy side shop that I've ever had, or any buy side firms that I've ever worked with, did not use DCF models, but they definitely had models. And I think what novice investors and people who are hawking DCFs, I think they sort of provide this false sense of comfort because you do get a value at the end. But in a DCF model, 70 to 80% of the value is in the terminal value, right?
That's
so
right.
It's kind of like the inputs are much more important than the actual output. And it's fine to create a DCF. You just have to understand that the inputs you're putting in, you should understand how they affect the output. And that's the most important thing, because the discount rate that you use, the terminal value growth rate you use, are just going to overwhelmingly drive the overall value of the stock. So to say like, hey, my DCF value for a stock is 100, it's trading at 80, that's just not like, that's not a great thing to take away. Whereas much more important is to say, well, my DCF value is 100, and if I change my growth rate over the next 5 years by X, how does that impact the value or the margin or whatever it is? So like you said, in my experience, models are great for helping you understand the drivers and not for actually getting the end answer or the end value for a stock. So that's interesting the way you described that, because I found a similar experience.
Yeah, totally. You nailed it.
Cool. No, you nailed it. Okay, so that's kind of like all the questions I had, and wanted to get into some investment ideas from you. So I think you have 4 stocks for us today to talk about: Twitter, Stitch Fix, Upwork, and Wayfarer. So let me share my Koyfin screen, and we can go through some ideas. Hold on one sec. We'll turn off the camera here. All right, so let's talk about the first stock you wanted to discuss, which is Twitter. And I'm just going to pull that on my screen over here. This is the 5-year chart, and actually let me compare this versus kind of like Twitter, internet, and Facebook over the past kind of since Twitter went public. So why don't you tell us kind of like what has happened with Twitter over the past couple of years, and what you're thinking now? What's your thesis?
Yeah, absolutely. Yeah, so Twitter is a very interesting one, kind of I would say maybe battleground stock in some ways. The social media ugly duckling, I guess you could say here. You can see on the chart, Twitter's stock has basically underperformed most of its closest peers. And that's despite, significant revenue and operating profit growth over the last 5 years. But, Twitter has this amazing asset. It's a kind of unique non-replicable asset in the Twitter network. And it's a place that people go for real-time news, for different topics of interest. We use it pretty significantly for finance and finance Twitter. But the story of the company is interesting because on the one hand, you have accelerating user growth. Over the last 5 or 6 quarters, Twitter's user growth numbers have accelerated, and they're the healthiest they've been in many, many years. So while at the time that you have accelerating user growth and accelerating usage, the revenue growth has been decelerating. So revenue has been decelerating and operating expenses have been growing faster than revenue. So what you have is margin compression and profits and free cash flow going down, while the user growth has been really, really good. So that essentially has kept the stock flat over the last few years, which is a pretty terrible performance relative to, like you showed, the either internet stocks or Facebook or Snapchat. So a lot of people are frustrated with Twitter. They think it's mismanaged. They think the product is, slow to add features, which I totally agree with. With the hundreds of millions of dollars that Twitter spends on R&D, it's surprising that, they don't have more to show for it, frankly. But that's kind of all rear view mirror thinking. When I look forward, I see some interesting dynamics with Twitter. Like I said, unique asset. They've got accelerating user growth and usage. The platform has never been more useful. Now we have an activist investor on the board with Elliott Management pushing for change from the board level. Silver Lake private equity investors also involved. And there's signs that the company is starting to really work towards faster product velocity, product development. They're working on a new advertising engine. They're working on new ad formats reportedly. So there's a lot of positive things, I think, as we look forward on Twitter. I think what Twitter can be is a much, much better business. The incremental margins in the business are very high. So for every extra dollar of revenue that they get in the future, I believe somewhere between 40 and 50% of that will convert into profits or free cash flow. So if they actually show some expense discipline and start rolling out better monetization over the next few years, as I think they will, I think the stock can be up 2, 3, 4x from where it trades today.
And it's so interesting here that visualizing what you just described in terms of revenue, which actually has been growing. It's sort of plateaued over the past 2 quarters, but it has been growing for the past sort of 2 to 3 years, whereas EPS saw this bump up and then has been stagnant and has been coming down ever since late 2008. It's sort of been flat there. So meaning that the revenue is going up, their EPS is going down, staying flat, meaning that they can't control expenses. And the funny part here is, or the sad part, it's maybe not that funny, is that the higher expense isn't leading to innovation. It's not like they're rolling out new products, like you said. And like one of the criticism, I guess, of Twitter is that they've been sort of stale for the past, like, what have they really introduced over the past several years that's new and that's not part of their core platform? Whereas you think about kind of like what Facebook has introduced and all the pivots it has made to obviously Instagram and stories and all that other stuff, Twitter is kind of like sleeping and not really doing much.
Yep. 100% agree. I've had a lot of criticism for Twitter and the management team at Twitter. They shut down Vine, and Vine could have been TikTok or something similar, right? And what have they actually produced in terms of new product features, things like that? Brand advertising is the dominant form of advertising on Twitter. They've never really gotten the direct response advertising working, which is what drives a lot of Facebook's high profits and growth. And so, yeah, I agree. Lots of things to criticize there about Twitter. But again, I think looking forward, that's where we have a disconnect between, and that's why the stock has been weak. But I think looking forward is where the opportunity lies, because they do have the user base actually growing and, usage is healthy. And so I think if they can turn around that historical performance, I think we've got a potential rocket ship. But
yeah, and it's funny because Jack Dorsey's obviously CEO of Square and Twitter, and if Twitter had performed half as well as Square over the past 1 year, 2, whatever it is, would have been some happy investors there.
Yeah, I think it's really key here to get a full-time CEO in, or at the very least a COO who can drive the business while Jack is spending 75% of his time at Square or in Africa or whatever he's doing.
Yeah, But he seems like he has a lot of stuff going on in terms of like personal commitments, managing two companies, some of the holistic stuff that he does, and
Yeah.
it'd be great to get someone there who's focused and full time. And I think that's probably the number one criticism of Elliot.
Yeah.
And that's good that they have they've lit a fire under the management team there, and so that's good.
And I think, personally, I think that there's a middle ground here where, a lot of the Twitter employees, I think, and Twitter users are worried that kicking Jack out is going to lead to the decline of the platform, and it's going to end up acting like Facebook with, things like privacy or other issues that users care about. But, I think there's a really nice middle ground here where Twitter keeps Jack on as either an advisor or chief creative, and the culture, he helps with culture development, but then you actually get a laser focused COO and COO in there that can, drive really nice product features that I think users will actually enjoy and add products that advertisers will want to use. And so I don't think it needs to be destroyed just to create value. You know what I mean?
Cool. Yeah. And I like your point on like all the issues they've had. That's reflected. I mean, it's not, I don't know, like it's reflected in the fact that the stock has gone nowhere. So
Yep.
if you believe that those issues will be fixed, then this is actually an interesting point. And you could see kind of like this volume day the other day. I think this was a rumor that they're going to introduce subscriptions and so people got excited and led to this volume day. But I think it is clear, whatever they choose, that they are thinking about new ways to monetize and monetizing their huge engagement and user base.
Yep, absolutely.
Cool. So let's move on to the next stock. You wanted to talk about a Stitch Fix?
Yeah, Stitch Fix. Yeah,
Cool.
so Stitch Fix is a really interesting business. It's a subscription clothing business, or it started as a subscription clothing business. Katrina Lake, when she was in business school, decided that she wanted to offer her friends a product where they could monthly get a box of clothes tailored to them, and they wouldn't have to like go out in their busy lives and go to all the stores looking for stuff. And from that gem of an idea, she has built this pretty cool little business where the company is focused on not only sending people clothing on a subscription basis, but also building out lots of really interesting data-driven analytics and personalization for people around their apparel. And so the great thing about Stitch Fix is that a lot of people think of it, oh, well, it's a subscription fad, similar to like a Blue Apron or some other subscription business that ultimately is going to have high churn, and people will get off of it because they don't need that many clothes. They don't need clothes every month or every quarter at a certain point, right? But what they're missing is that this has the potential to actually be the new department store online. So e-commerce, we know, has had a huge shift. Brick and mortar has ceded tons of share, not only over the last decade, but it's accelerated in the past few months with the coronavirus shutdown. So we know that e-commerce has been on fire generally. And when you think about, the future of retail, Stitch Fix is one of those companies that kind of sits in this opportunity zone. They started, by the way, with women, but they've also expanded to men and children's clothing, which I think is great. So they have all these growth levers with not only new customer sets, new countries as well. They've expanded into the UK. I think there's plenty of other markets they can expand to as well. But what's interesting too is they just added the ability for their customers to buy apparel and other products from them on an a la carte basis. So if you were a traditional customer of Stitch Fix, you had your monthly or quarterly box that was sent to you with clothes that they think you'll like based on your past purchase habits and your fit and what you like. And that's great. But, occasionally we all have times when we need to purchase something that we need for that week or for an upcoming interview or something like that. Or maybe we decide we like a sweater and we want a second one in another color. So Stitch Fix now offers the ability for its customers to just go on the site and buy it as if they're a regular retailer that you buy on demand. And so what's interesting about that part of the business is it's a much, much larger business, a much larger market. You're now talking about the entire apparel purchasing market, and you're competing against traditional retailers like Gap and Nordstrom and whoever else. And it's a huge market. And as brick and mortar continues to cede share to e-commerce, the players that can that can do curation and do purchasing online in the apparel space well have a massive opportunity. And so Stitch Fix is sitting here with a lot of great, fantastic data on how to do personalization at scale. And they've added a la carte, and the management comments in the most recent earnings update suggested that the a la carte purchasing is exceeding their expectations from a financial perspective. So there's a really interesting potential growth tailwind here that could last for, I don't know, a decade or more. And no one's really focused on it because most investors still think Stitch Fix is like just a subscription clothing business for women. So lots of interesting growth drivers at the company, very good management team. You know, you've had board directors like Bill Gurley buying stock. Now he bought under $20 a share a few months ago, but you know, they've essentially aligned themselves with shareholders in certain ways and you know, bet on the company for a long-term type of bet. So some interesting things going on here.
So obviously they you could see kind of like here revenue declined a little bit, and the stock fell here when they I don't know, I'm guessing this is when they announced the revenue number.
That's right.
And so the market didn't like that. So there's obviously a controversy here with kind of like something slowing or something changing. And so you're of the view that they're going to figure out they have the relationship with the customer. Obviously the stock has been flat, it sort of declined and come back here. So there's a controversy here, and what's great about controversies is that if you're right, then you'll get paid. So it's not like the stock has already run a lot. And when I was looking at when you mentioned this to me, that you told me you're gonna talk about it, I started looking at the iBuy index, which is the online retail index, which Stitch Fix is a part of. And what I did was I looked at the market scatter plot, so kind of the equities market scatter plot. I'll just show you how all the viewers that don't know how to do this. I added an ETF here called iBuy, which is here. And then I looked at the percentage change year to date versus the short interest outstanding to kind of get a sense of what's going on. Just maybe look at it over the past 1 month, or just change that to, okay. Just to get a sense of which stocks have run up and which stocks have the highest short interest. And Stitch Fix here actually has the third highest interest in the index at about 22%. So short interest here has been rallying. So it gives you a real good sense of how controversial the stock is.
Yep, that's right. Yeah, it's one of the highest short interest stocks in the market and in tech over the last 6 months or so. And you're right. You pointed out that, you know, apparel is generally, even the e-commerce apparel retailers have seen a decline in business over the last quarter. You know, Stitch Fix went from growing 20 to 25% revenue growth year over year to about a 10% revenue decline in the most recent quarter. So in the short run, the economy and the pullback on apparel spending specifically is not helping. But that's where I think there was a mismatch between the stock and kind of the longer term opportunity. You know, as you mentioned, like the DCF, there's a reason that, you know, 80% of the value comes in the terminal value. It's because, you know, we know the value of a company's stock is not based on what they're going to do this year, but, you know, many, many years out into the future in terms of profit and cash flow generation. And so I think if you look a little further out on Stitch Fix, I think that's where, you know, there's a lot of shorts that are betting against it right now because they think that it's a fad or that, you know, apparel is going to continue hurting, which may happen over the next few months. But I think the interesting potential is what you see when you look out, you know, on a few years time frame.
Yeah, and so maybe this is a good time to actually go into one of your next ideas, which is Wayfarer.
Yeah, another highly shorted stock, battleground stock.
Another highly shorted stock. So here on this iBuy, which is the online retail ETF, only two other stocks here have higher short interest, which is Carvana, online cars and pets, obviously online pet products. You're not pitching these, so you're pitching the next two, which is kind of cool. That's actually typically you want to, like when I'm looking for longs, you want to be in this region over here, because the extremes are, I don't love touching the extremes, but these are kind of interesting to think about. So tell us what you're thinking with Wayfarer.
Yeah, so I should mention, I actually don't hold a position in Wayfarer currently. The reason I think it was interesting to bring up Wayfarer is because during the sell-off, it had one of the most dramatic sell-offs and one of the most dramatic recoveries this year. And, I was fortunate to pick some up like in near the bottom. I think in the mid 30s, around 35 is where I made an entry into Wayfarer.
Mm-hmm.
Have since sold it, but I do think still there potentially is still opportunity for Wayfarer to grow long term in terms of its valuation. But I think the risk reward profile's changed a lot since it was at $35 and now it's at $227. But the thing that was easy for me to see, so I've been following Wayfarer for about 2 years, and the idea here is that Wayfarer is pretty misunderstood in terms of its financials. You can look at the fact that they've been growing revenue at around 30% a year consistently for the last call it 5 to 10 years. But the knock against the company has always been, well, they're selling more, but they're just increasing losses over time.
Mm-hmm.
And that is sort of true, but really they've been running the business at closer to break even. In the last year, losses really accelerated, and you can see that like on the income statement that in 2019 things got significantly worse. But that was because they were entering new markets in Germany and Canada and rolling out more like distribution centers and warehouses to kind of support the overall business. But when you hear Niraj, the CEO, speak on conference calls over the last couple of years, they're running this business intentionally at a small loss. When you look at the cash flow statement, you'll actually see it's much less bad because they have the negative working capital benefit. This is basically what Amazon looked like, 15 years ago in the e-commerce business. And, a lot of people said for the longest time, well, Amazon loses money. They're never going to make money. How do they keep supporting these losses? Well, if you look at the cash flow statement of Amazon back then, same thing as Wayfarer here. They get a benefit of the negative working capital as they grow. And so that helps them actually finance the losses in the business, and they can continue building a moat around the SEO, around the brand. And over time, the idea is that, they get enough repeat purchasing and brand that they don't have to keep spending on marketing dollars or not as many marketing dollars to drive future sales. They can become essentially the number one or number two player in the furniture category online, which is a huge category. And although the margins are small on buying and shipping furniture, if you do enough volume, then hopefully over time you have the scale to actually produce a pretty nice profit margin. And Wayfarer's management will tell you their long-term EBITDA targets, they believe, are about 10% EBITDA margins. And in their more mature markets, they've been able to actually hit profitability. And so if you believe that, and if you look through some of their financials and you can confirm that, then you get a better, deeper understanding that, hey, maybe this business isn't financially as bad as it looks on the face of it. And so, I do think, there may be some kind of structural competitive issues longer term, but when you look at one of the things I love using Koyfin for is being able to graph historical valuation metrics. Mm-hmm. And so if you pull up the historical graph of Wayfarer's like EV to sales multiple, the reason we might use an EV to sales multiple here is because Wayfarer doesn't produce profits right now. And so if you look at an EV to sales multiple history for Wayfarer, similar to Amazon, Amazon, when it just had the e-commerce business in the early 2000s, typically traded with like a 1 to 2 times EV to sales multiple before it had like the AWS business and all this other stuff. Mm-hmm. And Wayfarer.
Let's actually, hold on one sec. I'm just going to pull up Amazon into here just to kind of see this.
Absolutely.
On okay. Yep.
Yeah. So now you can see Amazon's valuation multiples increase significantly. But back in, call it, the 2003 to 2010 timeframe or 2003 to 2015 timeframe, you can see that Amazon typically traded somewhere between 1 and 2 times, or even slightly above 1 to 2 times typically EV to sales multiple as it was growing. Mm-hmm. And Wayfarer, prior to the coronavirus sell-off, was trading right, I think, around 1 to 1.5 times EV to sales, kind of chopped around. But during the coronavirus sell-off, I had been following this for a couple of years, didn't take a position. But during the coronavirus sell-off, it got down to an EV to sales multiple of like 0.3 times.
Right.
And so that, to me, was the time, like I was able to, a business that I'd followed for a long time, that, I thought still had a long growth runway and some interesting dynamics with it, got down to such I guess you could say out of range valuation, or a historically cheap valuation, that was the trigger for me to take a position. And I had to do some work too on the balance sheet to get confidence that they had the liquidity to survive. But they actually did raise a convertible note in, I believe, March or April as well, which gave them breathing room. And so that was the kind of thing that you could see without doing a full DCF model. If you're using Koyfin and graphing kind of the historical range for the valuation multiples on businesses like Wayfarer, which in a lot of ways resembles Amazon's e-commerce business back in the early 2000s. All you had to see was that this thing was trading at a statistically unusual valuation relative to history, so, and its peers. So I thought that was really the trigger for me that caused me to enter a position. I just thought the risk reward at that point was, significantly skewed towards the upside.
That's a really interesting point of comparing it to Amazon, because obviously Amazon today has a lot of other businesses. It's media business, it's cloud business, but back then the retail business was the overwhelming part of the company, and sort of really thinking about how and the bull case on Amazon is look, it's growing 30-40% a year in revenues. The bear case is it doesn't matter, it's never going to make money. And then I around 2014, 2015, this gap was really the first time that Amazon started showing that it could make money, it could be profitable in these businesses that people said it can't be. And that's when the multiple really started to take off and started to increase. And really interesting, kind of you point out, even after this big run, trading at 1.7, that's still where Amazon traded back when it was still a pure play retailer. And if the bull thesis on Wayfarer is it's going to be kind of the dominant position for online furniture, online home furnishings, then this kind of 1.7 multiple is still, it's nothing to really get scared about.
That's right. Yeah.
Awesome. All right. And then the last stock that you wanted to talk about was Upwork.
Yeah. Another one with a pretty interesting, I think, longer term growth story here. It's I would call it kind of growth at a reasonable price, which is kind of amazing to find in a market like this. But Upwork is one, and it's had a really nice run lately. So the risk reward there has changed a little bit as well. But I still hold it, and I still think it's got significant potential upside longer term.
So just looking at it real quick, for a SaaS company that's trading at 5.2 times sales, that's actually in the kind of relative to some of its peers, that's actually pretty cheap. And that is that what you, or are you looking at other measures?
Yeah, absolutely. And yeah, there's a couple other metrics you could look at here too. If you look in the financials analysis, you'll see their gross margins have been really nice and, over 70% and improving over the last few quarters. And so they're pushing, now over 70% gross margins. And so if you could also look at metrics like EV to gross profit and things like that. They're similar to a lot of the other high growth tech businesses. They're running at a break even or slight loss. And so, metrics like PE or price to free cash flow aren't really relevant right now. But what's nice about Upwork is they have a pretty long runway of growth as they become, the more and more dominant number one player in freelancing and in a market. They're essentially a marketplace for companies to find freelancers and freelancers to find work. And they have kind of two parts of the business. They've got the normal consumer part that you would think of okay, you're a graphic designer, you get on Upwork so that you can find interesting freelance graphic designer jobs. And maybe you're a small business and you need a logo designed and you go on there to find this freelancer. But they also have now been pushing into the corporate side of the business where they have longer term contracts with companies to basically be flex labor. So if you think about this kind of shift we've had in working from home, and obviously a lot of the uncertainty around demand and unemployment, there's potentially an acceleration here in the opportunity to use flex labor as well. So companies can sign contracts with Upwork, and Upwork provides them with higher quality flow of employees or potential freelancers who can carry out different types of work that those companies need done. And the companies don't have to do the full-time hire with healthcare benefits and commit to, kind of a longer term hiring decisions. They can use Upwork to kind of flex around their labor needs on the margin. And so the corporate business is interesting because it is more traditional SaaS-like. I wouldn't call it, pure SaaS, but it's similar in the respect that you have longer term contracts with pretty good margins, and the companies are, you see, it takes some time to sign up the companies. Obviously, you need an enterprise sales force, but the longer term returns from that can be pretty significant, and the revenue can be pretty sticky. So that's I think an interesting part of the story. And when you look at the financials, like I said here on Koyfin, you can see improving margins, revenue growth that's been really, really consistent and nicely above 20% year over year. I think that potentially has room to continue to be the case, 15 to 20% revenue growth for many years out. And you can also do things like look at its valuation relative to other SaaS companies, look at its valuation relative to, say, Fiverr, which has had an unbelievable run as a stock as well, and see that it looks pretty cheap on some of those metrics relative to some of its, what you would call its peers. In fact, if you pull up if I pulled up a dashboard about a month ago on SaaS companies and compared Upwork, and it was basically in the bottom decile of valuation relative to a lot of others.
On EV to sales.
Yeah, EV to sales, EV to gross profit.
So if I just pull up here my SaaS dashboard, and I actually don't know if Upwork is here, and I choose my valuation here, and if we kind of sort by valuation, so this is kind of like what you're saying in terms of these companies trading at EV to sales multiples. There's only a handful of companies that are trading at sort of 5 to 8. And actually, let's put on Upwork here to see where it trades.
Yeah, and your average or median there is probably going to be about 12 times sales.
Yep. And you'll be happy to know that in the next version of my dashboards, we're going to have averages and medians. So we'll be able to more easily tell. But here I added Upwork trading at 5.2 times EV to sales. So way cheaper than anything else on a relative basis. And like you said, if we look at the financial statement and just think about these revenues growing, these revenues kind of growing very steadily. That's looks like it's a pretty interesting growth business. And then Travis, do you look at technical analysis at all?
A little bit, yeah. My business partner Chris, he lends a hand a lot. Him and his wife Nikki, she's actually a certified financial planner, but also has some experience trading, and they focus on a lot more swing trading type of opportunities, and they help me kind of add the technical side to my fundamental bias.
Because I if you didn't tell me kind of what this company does, and by the way, we use Upwork at Koyfin to hire freelancers. And probably should have started what this company does. And basically, it's a marketplace, as you mentioned, for freelancers to find work and for companies to find freelancers. And probably one of the largest companies in the world, or marketplaces in the world, doing this. And so in this new environment where companies are watching costs much more judiciously, and working remotely is just part of every company's fabric now, or is going to be part of every company's fabric. This Upwork network is going to enable companies to find these freelancers. And if I didn't know what this chart does, I'd say, wow, this is a pretty good technical setup, because the stock was going down here, whatever happened, and now it's kind of reversed this trend in a significant way on this really big volume. And I love this kind of up on volume, consolidating, now up on volume again, making new highs. And like you said, this is pretty rare to find a SaaS company that's sort of hasn't run up, as much or trading at the 52-week high or 3-year high. So on the technical level, very cool setup, very interesting to watch.
Definitely.
Cool. Awesome. And then out of the 4 companies you mentioned, Twitter, Stitch Fix, Upwork, Wayfarer, what do you think, let's say kind of medium term, what's your favorite one if you had to pick one?
Well, I think Twitter is probably the one with potential catalysts that are more near term than any of these. So I think, Twitter is probably more actionable near term. But I also really think, I really like Twitter from the standpoint of it's got so much low hanging fruit.
Yeah,
They just need to get like 20% better at everything they do in terms of like expenses and product development. And, if they do hire a CEO, I think it's all a game. I think those are game changers if they just do a little bit better than they have been. And, Twitter's a stock. I think it's a company I think can produce several $billions of free cash flow a few years from now. And we're not that far out from that type of potential. And it still trades at like under $30 billion market cap. So it's one of those companies that price relative to its potential is still very, very cheap in my opinion.
interesting. Cool. Awesome. Well, let's just wanted to wrap up here. Ask my guests something kind of like personal. Everyone's stuck at home. Everyone's sort of watching Netflix movies. Not a lot of stuff to do. Can you share your favorite movie or TV show over the past year and why you like it?
Sure. Great question. I've been pivoting with my fiance from show to show lately, trying to find good stuff. But I would say we watched this recent one, 000 on Amazon Prime, which I think is still relatively under the radar, and really enjoyed that one. The story is basically about a drug trafficking ring, and it kind of covers different sides of it. And it's very, very well done as far as like character development. And it's, pretty, I think it's a pretty gripping show to watch. So that one's pretty great. I've also really enjoyed like The Last Dance, the Michael Jordan documentary, and Unsolved Mysteries, which is a show that I used to watch as a kid and get terrified by. That new one on Netflix is we're about 1 or 2 episodes in, and that one's been pretty good too.
I just watched Ghost with my wife who'd never seen Ghost.
Oh wow!
And I remember as a kid, I was always scared watching Ghost, and it's pretty silly the special effects, and it's funny being scared by something when you're a kid
and rewatching
and rewatching and just sort of laughing at how silly it is. I will need to check out Unsolved Mysteries, and although I'll probably still be scared.
Did you ever watch that when you were younger with the?
I know. Is it like
Yeah, so when it was on, I think in like the 90s, the narrator there, you can see the guy at the top. Forget his name, Robert. I'm blanking on his name all of a sudden, but he had the most like I guess the word terrifying is appropriate. The most haunting voice that he would narrate some of these what are already pretty kind of scary stories in some cases, like unsolved murders and things like that. And he would narrate it with this absolutely haunting voice, and so that was, I think, part of it too. But it's also kind of one of those where it's real stories, and so it's stuff that, as a kid at least, you're worried about somebody breaking in your house, and it's very, very unlikely, but it's when you watch these things, it makes it really hard to go to sleep. But I think that the new one doesn't have the old host. But if you go back and watch the old one, it's extra scary because of the.
Got it. So it's not like Seinfeld where you're watching old shows. It's a similar concept or the same premise, but it's new mysteries that they cover.
Yeah, exactly.
Got it. Cool. That is awesome. And then lastly, how can people follow you? How can people keep up to date with what you're thinking?
Yeah, absolutely. So I have Twitter is a great place to follow. I tweet lots of stuff around different thoughts and ideas, and so Twitter's great. That's just my handle at Travis Devitt. I also have a Stock Geek TV YouTube channel, and so I am hoping to get more active in putting out different analyses and ideas and things like that on my Stock Geek TV YouTube channel over time. So Stock Geek TV YouTube. I also have a Stock Geek TV newsletter that I do longer investment write-ups like the one on Twitter. So yeah, any of those places I think would be great ways to kind of follow what I'm doing.
Awesome, and I'll put those links in the YouTube description so people can just click on them and find them pretty easily. Travis, this has been a really interesting conversation. Thanks for being on and all the ideas. Hope to have you on again soon.
Absolutely. Thanks, Rob. We love Koyfin, so great to be here. Thank you.
Love to hear that. All right, bye-bye. All right.